All right, welcome everyone. Welcome to the CoinRock Show. Today we have Chris J Snook in the house with us today. Very interesting conversation that's going to happen now. As you guys know, we don't script these in advance. I have a few bullet points that I want to cover with the guests. But yeah, Chris is here. A lot of experience in a lot of different fields that you guys, I also have ventured in, whether it's on the acquisitions, exits, Web2, Web3. And so, there's so much happening in all these spaces that I always like getting interesting guests who are doing things, not just the talkers, but the doers. And yeah, welcome to the show, Chris. Let's dive right in.
I'm excited to be here. You guys are doing some great work, and I'm a big fan of the platform and the show. So
I
happy to be a
appreciate it.
guest.
Thank you. Yeah. So first of all, maybe give a this is your time. So give everyone an overview of where you come from, what led you to leading the funds that you lead now, and the investments, etc.
Yeah, I got started in just mid about 1999. So it's hard to believe time flies. It's
Yep.
25 and a half, 20 some odd years ago, and you know I don't think early on it was very conscious, like where I was going to end up. I was not from technology. I was certainly not from a family that was entrepreneurial or did ventures or funds or any. I mean, that stuff really wasn't on my radar.
Yep.
What's relevant is I fell into the awareness that I had the affliction of entrepreneurship before there was social media, before it wasn't really a career choice back then. Now it's kind of like something they teach in graduate schools, and
Yep.
and that everyone aspires to be. But
It wasn't cool to be an entrepreneur before. It was almost being on the fringe of like weird.
yeah, I mean, a lot of your audience may not even have been born when I started, right? And some of
Yep.
them, can remember back, but the 90s is kind of coming back into trend now. Like our son is into like a lot of the generation Alpha and Gen Z's like kind of look at the 90s, and it was a really unique time because the internet had become global. It was
Yep.
the early days of the internet, and yet we still had a really analog life, not just in business, but
Yep.
like in life. I mean, I graduated college in 1998, my undergrad,
Yep.
and I was probably one of the last people, the cohorts of society that graduated without a cell phone, without a
Yep.
computer on my desk. I typed my final paper on a Brother word processor that had a green screen with 4 lines of text. It
Yep.
held like 64 kilobytes worth of storage. So it would hold like 3 or 4 Word docs at a time. You had to delete one to
Yep.
make, and then you fed paper into it just like a typewriter. So it was really a glorified
Yep.
typewriter. A year later, I went into grad school in 1999 out in San Diego, and I bought my first PC, and it was, huge, big, heavy thing.
Yeah. It was like a
And I
shelving
got my
unit.
first, and
I
I got
mean,
my first,
legit, like these big boxes, right?
yeah, I mean, you wouldn't even be able to lift it now, right?
Yep.
It's so heavy.
Yeah. Yeah.
And I only got it because I was going into grad school, and this thing called Blackboard, which I don't even know if it's still around, I'm assuming it is, but Blackboard was kind of the first time they put syllabuses and things like that online. And you had to have an email address, which the school issued me, to go check your syllabi. They still printed you off a copy if you asked one, but that's kind of that first thing. So I say all that
Yep.
because um, so much has changed so fast. And then if you fast
Mm.
forward to, so I built my first company, never got to revenue, lost $500,000, never getting into revenue, my money and some friends and family, and I learned a ton, right? Spent 2 or 3 years basically in a variety of different industries, from wholesale finance to private equity to direct sales to, I mean, it really didn't matter because I needed to make $500,000 back, and I had never made, that ever, like, let alone, knew how. So I was pretty much just following
Mm.
where the market was telling me it was going next. And I didn't really explain it to people that way. It was just like practical. It was pragmatic. I was like, I don't know how I'm going to get out of this hole. And I've just got to go where it makes sense, where the money is moving. And so that's kind of what iterated into a decade, that first decade. Now in '09, I very intently moved into technology.
Hmm.
And it was not because I came from it. It was because I had had enough of my teeth kicked in. I had had enough um, lessons, and then I had had a couple of successes, enough to like kind of, I was back even. I was, in '05, I paid all the debt from the old one off, and I started to make real money for the first time. And then in '08, not because of the crisis, I actually had it before the crisis. I got my clock clean, $2.7 million wiped out, like back to zero. Um, and and so it was through that I started to look at, well, what kind of entrepreneur am I? Again, it
Mm.
wasn't something that was defined. The best thing we had, what you guys have right now with podcasts and things like that, was going to Barnes and Noble or Borders Books when they were
Oh
still
yeah.
around, and
That's
buying
that's how I
audio.
started too. It's just books. There was no YouTube. There was nothing.
And you had to pay. I mean, I remember spending, I think I spent almost 30 grand, maybe 20 something thousand dollars on credit cards and things like that while I was in
Yeah.
grad school getting another education in business. I spent that at Barnes and Noble and Borders over a period of 2 years because I
Yeah.
wasn't a fast enough reader. And I was like, well, I need to listen to it while I'm in my
Yeah.
car and doing things like that. And I would just go buy whatever was next on the shelf. I didn't even care because I didn't know anything. So I was just like, I'll just, okay, Tony Robbins, fine. Okay, now Kiyosaki. Okay, now fine. Now John Maxwell. Okay, let me learn about
Yep.
leadership. Let me learn about teams. And so I have a box to this day in my office filled with tapes and then CDs
Yep.
from that era,
Yeah.
and
Yeah.
Dale Carnegie, and everything I could get my hands on. And I say all that because, again, it's a new world now. So the
Hmm.
good and the bad of it was, I have this pattern recognition of, I never saw myself as a futurist. I think of myself as a pragmatist. That means I'm observing the present, but I understand that this future is unfolding rapidly. And I've been through a couple cycles now. The first one, I didn't even know what was going on, right? 2001 happened. I didn't even know what was going on. I just
Yep.
saw tech crashing, and I saw venture capital not forming again. And I was bootstrapping a business, and it was nothing to do with taking in investors like that. In 2007, '08, I kind of saw this macro shift of, kind of a reset, basically, where we
Yep.
turned money from, I mean, we really went from money into debt, like where everything is just debt after that, right? Because we
Yep.
essentially turned the US Treasury into money, which is nothing but debt. And so we fueled this kind of 0% interest run for 15 or 16 years straight. Zero being, directional,
Yep.
right? It wasn't always at
Yep.
zero. Everybody knows that. But when I started, interest rates were like 7%. I remember my first mortgage, I had a paper, bought my
Yep.
first house for $195,000 in Oceanside, California, put 3% down or whatever. And my mortgage was like 1,600 a month, because even with a paper, I was paying like
Yep.
7.25% interest on a
Yep.
30-year fixed. That wasn't that long ago. And people are freaking out now, going, oh my God, interest rates. But
Oh
it's
yeah.
like, we're kind of back to that, but we've had this insanity. So the perspective comes from understanding that we've kind of got this everything bubble. If anybody's ever read that book, it's a great book.
Yep.
And we can't really unwind it. Like, there's these forces that are just in play. And because if we did, like, if we just unwound it all at once, it's kind of like, I now judge it too. If you have a cancerous tumor and it weighs 300 pounds, but you only weigh 325 pounds, you can't just cut the tumor out, because it
Yep.
has blood vessels and circulatory. It has so much running through it that you'll kill the patient. That's the economy,
Yep.
right? Like, we can think all we want about the Fed and this and that, and then the Fed. And I've read Creature from Jekyll Island back in 1999. I've read it 5 times, I think, over the last 25 years. I've spent an hour and a half in the car with G. Edward Griffin, one of my favorite experiences ever, taking him to a studio to do an interview back in
Nice.
2011 or 12. And fascinating guy. And I'm 1,000% like, with the people that are going, oh, that book, we need to change it. It's just not practical. Even he said,
Yep.
you can't just cut it out. You have to replace it with something. So for those who have read Fourth Turning, first time I read that was in late '08, '09. It was written in '97.
Mm.
But I was
Hmm.
coming off of getting wiped out. I was going into technology, and I wanted pattern recognition. So I was like disclosing my biases up front before anybody listens to me about what I'm investing in or what I'm doing. Because look, all I know is I've tried to prove my biases wrong.
Yep.
And every time I've added a new nuance to them, and it's usually shaped by a conversation like this, or a book, or some data, or a combination. But it's important that you understand where my bias comes from, right? I'm a
Yep.
fourth turning guy. I see it playing out in real time, and I've been that way since '09. I've invested my entire strategy, even when I've made mistakes in the last, whatever, that's 15 years. I still hold to that thesis.
Yep.
The Watchman's Rattle by Rebecca Costa, another major one for me, which talks about how human beings biologically can't continue to invent complexity at the rate they do without collapse, because what happens is we invent problems we don't have the answer for. And
Yep.
there's memes that show up, and some of these super memes that happen in society are gridlock. Well, we see that. Replacing fact with belief. Well, we see that. Social's amplifying it, but we do it organically, right? And
Yep.
so these are important things to understand. Connectography by Parag Khanna, totally different kind of, political bend, but the data that he supports talks about how essentially connection points versus borders are the new macro. And it's the role of borders still matters,
Yep.
but role of connection points when it comes to data flows and supply chains and things like that is also a predictor of where things are going to move, including opportunity, humanity, migration, net migration. So you can go to my website if you want to see the books I've read, and you can figure out really quickly my bias, and you could challenge it or you could debate me on it, and I'd love that.
Yep.
But I say all that because it's important before I start talking about what we're doing and anybody thinks it's a good idea, that you understand why I think that way. And, maybe you don't, maybe you have different information. And so you can make an informed decision for yourself.
Yeah, I think what's really interesting is that you've been through these cycles, right? So people think that when I say cycles, I talk about crypto cycles. I said, no, no. I started browsing the internet late 90s. I'm a bit younger than you, so I regret not being older at the dot-com bubble. The first websites, I mean, I started doing paid advertising on Overture over 25 years ago. No one knows what Overture is today. I started browsing Alta Vista. No one knows what
Oh
Alta
yeah,
Vista is today.
Dogpile, all the good ones, man. Like, they're
Yes,
great.
yes.
They
And
didn't
so,
do anything. Remember when you would find a page, you'd search for something common, and a
yep,
page would go and say, "Sorry, there's nothing for that."
yeah,
Like,
yeah.
even that,
The
the advertising could
hyperlinks
tell you.
didn't work half the time. I mean, it was a different time. And
Yep.
so what you see in tech today, like in 2025, we've seen this, we've seen this a few times, and that's actually, you connect the dots much faster when you've seen these patterns before. So, I think it's a big benefit if you can work with your bias, um, and not be a victim of the bias, because some people are just stuck in the same routine that they saw 20, 30 years ago, 10 years ago. But if they can be open to new opportunities while using the patterns that they've managed to gain, that's where the alpha is. So let me
Yeah.
ask you, yeah, go ahead.
No, no, I was just gonna agree. Yeah. Go ahead.
Yeah.
Ask a question. We'll keep going.
Yeah, I'm just what are you seeing today that is similar to what you saw 25 years ago? And why does it matter basically for people? What's the same? These cycles tend to
So
come
that's
up.
a great
What's the
question,
same?
actually. I'm thinking about it. That's a great question. Because we can always talk about what's different,
Yeah.
right? So what's the same?
Yeah.
Human beings are fundamentally the same, right? So
Yeah.
if you kind of study technology cycles, forget what it is. I'm glad you brought up, like, we talk about cycles. A lot of people default right to crypto, and that's important because actually that is a major cycle, phenomenon that we need to kind of pay attention to because it is the future,
Yeah.
right? Tokenized digital asset. Like, I'm not talking about one chain or the other. I'm just saying there is no future that does not include, in a digital economy, a digital network that moves value around
Yeah.
and money. I mean, it's just physically, like, you don't have to be a rocket scientist to
Yeah.
figure
There's no
out.
going back. It's
Yeah,
here. It's only growing. Yeah.
you wouldn't be able to use this device, the mobile phone, if you
Yeah.
had to do this, the rotary dial, right? Like, it's obvious, right? So there's things that are obvious. What's not obvious is how they're going to play out and who the winners are going to be. That's not always obvious, but you can kind of, so those things are the same. And human beings move on culture. And, the best definition of culture is just group habit.
Hmm.
And the way that I prove that to people is I'm not sure where you're from, but you're the one with the accent,
Switzerland. Yeah.
right? Right. But whenever we think about an accent, it's always the other guy or gal who has it, right?
Yeah.
So that's group habit. Like, if you're in Switzerland, I sound funny.
Sure. Of course.
But here you
Yeah.
sound, intelligent or smart, because in America, like, it doesn't matter. Like, British accents, Australian, New Zealand, like, there's certain ones where we go, they're smarter than I am. And we just do it because group habit is like, whatever, that accent has a certain pedigree, and it's all made up in our head. It's all group habit. And when human beings are confused, when they're stressed, when they are overwhelmed, when they're afraid, right? All these natural human things, they will always This is never going to change. Hasn't changed in the 10, 20,000 years of recorded history or whatever that is. They always will revert to habit.
Yep.
And that's an important indicator, because no matter what industry you're looking at right now, no matter what investment you're looking at, no matter what logically makes sense, the adoption curve is always going to be, what is the pain point? So again, more than 67% of the time, a human being, this has never changed, will choose to do something new, a new habit or a change of direction, because of pain. 33% of the time on average, they will do it because of an opportunity for gain. They see something they want, they don't have, right? Aspirational. So if 1/3 of the time we move because of, it's vitamins versus headache medicine. It's right. We know vitamins are good for us, assuming they're organic and they're not,
Do you know that?
we should take them, but we never miss taking a migraine medicine if we get a migraine.
Yeah.
Right. The minute that happens, we take a pill, and it doesn't matter if it's good enough or bad. It's just like, I need this now. But vitamins, we kind of forget, or maybe we let the supply run out, or we cancel the auto ship, because they're a nice to have, not a must have. So that's never changed, and that's never going to change. So my frameworks are very simple. It's what are the macro forces? That's one polar. What does the consumer need? And the need is partly what they want, but what they cannot live without. And it usually ties to some reversion to habit.
Yep.
And if I can identify that, and I understand what the macro forces are, which could be political forces, they could be financial forces, they could be technology forces, they could be cultural forces, they could be any number of things, right? But you look at them all and you go, okay, what are those forces piling up? What is that going to do to the human? Meaning, are they going to revert to habit? Or are they going to change? Are they going to change because of pain? Are they going to step into it, maybe lean into it because of opportunity, right? Or a mixture of both? And if so, what? And then the third side is, what's the competitive landscape? Meaning, who is positioned to solve for that? And then I'm just figuring out which ones I think might win the race.
Yep.
And so human beings are everything. Like, as much as we'll talk about AI probably in the back half of this, the reality is AI will be a fundamental force. It is not something we should be talking about in the sense of, is it going to work, or is it about it? That's irrelevant to me. Valuations are totally different than innovations. So valuations can fluctuate through market demand and hype cycles, and that's all real. But what's inevitable is what's inevitable. And one of the things that's inevitable that I don't hear a lot of people talking about is when AI hits continued scale, when it's implemented in every business model, whether it's a small business or whether it's a Fortune 100, which will happen just like electricity. When we got to became affordable enough 100 years ago in the late 1920s, we never designed a building the same again. There is nobody here that expects to see a sign in front of a Marriott or in front of an office building that says, we have electricity inside. Like, no crap. We have beds with pillows. No shit, really? Like, you don't get credit for that. And similarly, 3 to 4, 5 years from now, we're not going to be talking about, I have AI and I'm doing it. Like, no one's going to care. You will be in business or you will be not in business.
Yep.
And humans will not know what 95% of that AI is even doing. But they'll still have to operate. They'll still have to manage each other. They'll still have to work with each other. Humans will still buy from humans. In many ways, my bet is we're going to crave more human-to-human experiences because we're tired of the self-checkout. We're tired of the freaking fast food. I was in an airport in Dallas like a couple of weeks ago, and I couldn't buy a meal anywhere where there was a human on the other side. Now, I get like efficiencies, but at some point, like, I'm just not going to eat. Because you're asking me for the same $15 to $20 per sandwich, and it's not an experience.
No, there will be, it's a slingshot, right? So we're so far on the AI, on the AI journey that at some point there'll be a divide between human interaction, no cell phone. And you see this, a lot of experiences, retreats, hotels, where it's like no cell phone. And the other extreme, which is AI. But there's no going back. There's only how can we work around the evolution, because there's no going back.
No, and that's the thing is, like, binary And we're even moving into, maybe it's another 10 years, whatever it may be, who knows, but we're even moving into a world where compute will not be
Yep.
binary, right? And that's
Yep.
like when we talk about quantum, like when we are, all we're really doing is we're unfolding our essence in the market in real time. And we call it innovation, but the reality is we were the first quantum mechanical machines, human beings. This
Yep.
meat suit that I call, a shaved head and a fading beard and, and a body is not me. Because when I die, hopefully in a long time from now, when I die, my spirit, however you relate to that, my spiritual energy, the actual energy that makes up me, the thinker, the doer, the actor, the believer, all that, is going to leave, right? There's going to be a breath. It's going to exhale. We've all seen someone or know someone who's passed away. When that leaves, it's obvious that
Yep.
the energy has left the meat suit. And so when we've thought about someone, we haven't talked to in 5, 10, 16 years, 5 months. And then all of a sudden we get a text or an email or whatever. That's not on accident. So all we're really doing when we're putting these things into code is we're identifying the power that is us. Now, I'm not saying that the machines won't take over. The inevitability says they already have.
Yeah.
Because no one leaves their house without a cell phone in their pocket or a smartphone in their pocket. And you may as well put it under your skin because it's tracking everything from the speed to the language tone to the whatever. I mean, Alexa's bragging
To your
about now.
voice, to recordings, to what's happening. Oh yeah, of
So,
course.
so we haven't yet gotten to the place where we're like, oh, when they put it under my skin, then I'm going to revolt. No, you won't, because you don't value the privacy now.
Yeah.
You don't, like, you're addicted to it, and there's a whole generation of people that didn't grow up with a chance to know anything different, and
Yeah.
there's a whole generation of us who have forgotten. The only thing we remember is that at some point we didn't. And so I think it's not about binary, like, oh, everyone's going to throw away their smartphone and never get another iPhone. Like, no, you're already in that machine. What we will do is we will start to be more conscious. And the authenticity that you're seeing that shaped this last election period, even, with like kind of RFK Jr. and some of the podcast stuff, and like how people went to market with their campaign,
Yep.
even if they didn't end up staying in the race, you're seeing that move to authenticity. You're seeing it play out now in social. Like, I don't remember the guy's name because I wasn't a fan of his or followed him or whatever, but I saw a thing yesterday about a guy who like spent 12 years building up a massive following, 65 million people. And then he did this video that was kind of, it found
I
out that
saw
it,
the headline. I didn't read, but yeah, same thing.
yeah,
You could
like
destroy
basically
everything in like literally a post.
yeah. And in like 18 minutes of a video, he lost
Yep.
like his whole credibility because he took a check to fake a video that showed a Tesla basically driving through a wall and not
Yep.
recognizing it, but it was all staged and he had self-driving turned off and like they exposed him. And so you have this rapid feedback loop now
Yep.
where you could spend your entire life doing everything right, being patient, and you could make one wrong decision and bam, it's out there. You also have this world where someone could deep fake you and you could suffer those consequences unknowingly and
Yep.
unfairly and spend years trying to restore that reputation. And so I
Yep.
think because of those risk factors, we're just seeing a pendulum shift back to human to human. Because at the end of the day, dogs play with dogs in the park. Like they may have an owner that's got a leash and that takes
Yep.
them there. That might be our AI overlord, but we might be the dogs in the park. The reality is, as humans, will always have smiles on their face when they're around other humans, just like dogs are happier being around other dogs. They love their
Yep.
owner, but they relate to the dog in a different way. And I don't want to dumb it down, but at the end of the day, we shouldn't fear what we can't control. We should act on what we can. And
Yep.
part of that is, do I have empathy? Do I even know what that means? Right? Am I buying consciously? Am I paying a couple bucks more to buy from the local person versus Amazon? Not because Amazon's not convenient and I'm going to cold turkey Amazon, because I'm not. But like, if I can buy a pair of flip-flops for 20 bucks from a major corporate, or I can go
Yep.
down the street and buy it from my local shop, what I'm showing is that I'm willing to pay $15 or $8 premium to keep that in my neighborhood. And as that happens, and then you hit the macro of 70 some odd million baby boomers, 10,000 a day hitting retirement age, many of
Yep.
which own businesses, and more than 50% of small businesses in this country being no succession plan. And then you think about other things like financial services, like then you start to see lots of opportunity where you could roll up non-technical businesses, what we've seen anyway,
Yep.
And you could take AI tools and retool them because there's no technical debt and never have to talk with the customer about why you're doing it. Never have to talk. You're just trying to create a more human experience, but you're buying cash flows and then you're creating new enterprise value for an industry by essentially doing something that no one else can afford to justify. And that's what Atomic's
Yep.
doing right now, just as our thesis. But you can apply that to anything in the market. If you're just investing full time, you just have to look at like, what are humans going to actually do and question your assumptions.
Yep. So talking about the acquisitions and the roll-up model, which I know very well, so I'm happy that you opened that subject because we can really talk for hours about this. Um, when did you do your first acquisition? What was it? What did you learn? And what are you doing now? And how did that evolve?
Well, so what's funny, like Joe Pesci, if you've ever seen Goodfellas, like not funny,
Yeah.
right? Is that it took me so long to kind of do what we're doing right now. And
Mm,
why I say that is because not because like the timing's worse or better. The timing's perfect now. So the experienced person to me laughs because I go, there are no things as oh, sorry about that.
no
I'll
worries.
do that again. I don't know what happened. All of a sudden my phone rang. Let me turn it off.
Yep,
And it
yep,
kicked me out. Hold on a sec. We'll cut this in.
yep, that's fine.
I thought I had it on no disturb. Hold on. Okay. Sorry about that. So what's funny about it is that I've learned over 25 years and missed expectations and achieving things I quite honestly couldn't have envisioned in the beginning, but then also being frustrated like constantly because this didn't close on time or that didn't happen on time or
Yep,
man, I had to go find this or man, this partner did that and oh, right, like all the lumpiness of being an investor and
yep,
entrepreneur. I've learned that although sometimes it feels like you're missing an opportunity, there's always another one coming. Now, that being
yep,
said, some are definitely windows that are worth more value. Like I am energized today, like I was 25 years old. But I have the wisdom of an almost 50-year-old,
yep,
hopefully. And part of that wisdom is realizing I can only do what I can do, right? You got to stay within yourself, but you can push yourself and your teams to the limit. But you just have to recognize like there's just an abundant amount of potential inside of you and inside the market, and you're never going to materialize it all. And even if you did, you'd be looking for more, right? So
yep,
you got to stay within yourself and you kind of just got to do the repetitive thing that moves you closer in the direction of where you say you want to go and focus, 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 focus. And so I've been in startups not because I thought I was going to be a startup guy, but I've been in startups since like 2009, right? In one way, shape, or form. And I don't want to say I fell into it, but there was a repetitive nature to once I got started, then I kind of fell into it, right? Just because
yep.
you start to build a brand, you start
Yeah,
to
and you get better, you improve, your skills improve.
yeah, and then your networks start to mirror that,
Yep,
right? So you're around other people that are in the ecosystem of
yep,
startups, and then so then it becomes like it's like just downhill for you, even if you hit cycles and they're like, oh, I wish I was something else, right? Um, and so you constantly have to reinvent yourself, but at the same time, you don't want to throw out all the value that you've accumulated. And so why I say all that is because when I go back 25 years ago, like my goal was very simple. I had two goals. One was not financial at all. First one, which was the most one that served me the most, was I wanted to be able to add value to any conversation with any person at any level in society, any boardroom, basically.
mm,
I wanted to be able to sit there and know I belong there and be able to add value to the conversation, even if I only said one sentence.
yep,
And because of that, that forced me to become voracious about reading, studying, analyzing, working on myself, working on my communication, working on my sales skills, working on my abilities to build rapport, empathize, because you can't be what I just said if you don't have mastery of all those facets,
yep,
right? So I worked on my inner game, and that served me really well the last 25 years. The other thing that I did that I kind of got away from without realizing it was I wanted to basically become cash flow independent. That was my singular
mm,
goal. I didn't have a
yep,
number like, oh, I need 20 million, I need 5 million, I need this, I need a billion. Like, I didn't do that. I literally started out going, I think I can live on 75 grand a year. How fast can I get
yep,
$75,000 a year coming without me having to kind of trade time for it? Right. And then I went a whole decade where cash flow was the last thing I thought about because I was investing in high growth startups or starting them or whatever. And
Yep.
some worked, right? And some didn't, but I was always the last guy to get paid. And I was always, and so
Yep.
I'd have an exit and it would be like 3 steps forward, but I was paying off the 2 steps I took back from the last one that didn't work. And
Yep.
so I've done this like in the right direction,
Yep.
but I hit a point where, added 2 more kids to the mix this last year, thankfully, after a decade, 12 years of trying. And like all these different things start to hit you, and you sound like an old guy when you say this, but you just
Mm.
become very conscious of opportunity cost. And even
Yep.
though I've said that before, every investor has said that, right? Opportunity cost, but it means something new every single year.
Yep.
And
Yep.
now it's almost like every month, opportunity cost is something that means something more to me. And so
Yep.
I started to really look at, and I finally got to a place in life where I basically have all the things I want.
Mm.
Right. And
Yep.
again, I have nice things, but it's modest compared to what people might think. But it's like
Yep.
I can truly say, I'm good.
Yep.
The only thing that I want to provide now is more presence, which means more stability. And so
Yep.
I started looking at in the whole dynamic, because again, as entrepreneurs or investors, when we're challenged with cash flows or lost trades or positions that we're not sure, whatever your mode of making money is, we're not present to whoever we care
Yep.
about being present to. Like it's just
Yep.
impossible, and rightfully so. And I know one thing about myself: this brain is never going to shut off. Hopefully,
Mhm.
knock on wood, until I go on the
Yep.
ground. And so I can't delude myself that I would be happy just retired, sitting around playing golf. Like there's no way I'd figure out
Yep.
a product to invent that would make my golf game more efficient or
Yep.
better, more enjoyable. Like there's just
Yep.
no way I'm going to
100%.
stop.
Yeah.
So once you recognize you have the affliction that you're never going to stop, and you embrace that as not something wrong with you, but something that has to be managed at times,
Yep.
right? Because I can be manic, not not in like a diagnosable way, but in other words, I get up at 3 and I go and I have kids and like some
Yep.
nights I don't sleep more than 5 hours a night. I get sleep. I value sleep. So I make sure I average 8 a week or 8 a day, but it's like, it's just not reality. And so
Yep.
I say all that to say opportunity cost is what has me now focused on the macro that I see, which is there is
Yep.
not an asset class right now that I care about more than these two things: cash flowing businesses
Yep.
and Bitcoin.
Yep.
That's it. Debate me on either one of them, happy to. But right
Yep.
now, the only two assets that I want are Bitcoin.
Yep.
So I've gotten rid of more than I'd like to admit, making payrolls or doing trades and investing in startups and things like that. And I go, oh my God, how come I never thought about the capital cost, like the opportunity cost of
Mhm.
6% a year ARR
Yep.
averaged over the last 16 years? Did I make investments that were worth more, that I knew going in had a really
Yep.
clear potential to do better than 66? Because if I did, good. If I didn't,
Yep.
I didn't. Why the hell did I do that? Because I could have just bought this and sat on it
Yep.
and be better off. And so those two kind of things, with the pattern recognition and realizing that I can't do it forever, and realizing that I'm getting older, and realizing that I have kids that I want to be present to, and all those things that come only as you get older and as you
Yep.
start to value things differently, have me going, where is the best use of Chris Snook's time, energy, and talent? And where it is connecting dots. And so that's why now we're focused 100% on acquisitions.
Yep.
And the new fund, which we are, formed just right now, with Atomic Capital, is focused solely on buying those assets and
Yep.
basically then harvesting those cash flows in a mixed treasury strategy where we keep the dry powder for rainy days, and then
Yep.
50% of it is just held in Bitcoin on the balance sheet. That's the model moving forward. And the justification is, okay, what if Bitcoin goes to zero? Probability next to zero,
Yep.
especially now, right? But I believe that 7 years ago, 8 years ago, I just didn't know how long it was going to take. But I like, there was a lot of things along the way where you go, this thing is unkillable.
Yep.
But the reality is you still have to look at it and say, well, it's possible. So because it's possible, I need to factor it into my risk curve. Okay, so if it goes to zero, what do I have? Well, I took $100 million and I bought $60 million to $100 million worth of cash flows in US dollar
Yep. Yep.
annually. And I improve those enterprise values with AI and operational efficiencies and roll-up strategies and all that stuff, and I prove those things. So I'm going to get a premium to the multiple on the market, whatever that may be.
Yeah.
And I'm looking out over a long-term horizon of a decade, not 3 years, 5 years, but 5 years I'll be ready to harvest some. But like I'm looking out over the 10 years because I'm like, hey, look, that's not that long, and I've been doing this for 10 years.
Yep.
I'm going to shift my strategy. So $100 million in free cash flows on 100. If the Bitcoin goes to zero, I still have $100 million worth of free cash
Yeah.
flows.
Yeah. Yeah. Oh yeah.
Right? If it doesn't go to
Yep.
zero, we're not even worried about what the hell the cash flows are.
Yep.
Right. And so that's the game plan now. And the market for that is just, it's too big. Like I
Yep.
literally don't even matter. And I can go create $1 billion of value for the investors, which are a handful of family offices that we're working with. And like it doesn't require me to win. Like
Yep.
I just have to play. And the reason why I say that is, and I'll shut up, but I'll give you an example specifically if you want to know what I mean by that. But I'll take a breath so you can ask something in there first.
Yeah. I want to get into examples and come back on something. Go ahead.
So, like for example, one of the areas that we're focused on is registered investment advisor practices.
Mm-hmm. Mm-hmm.
Right. So about 70% of our strategy right now is going to go into buying up RIAs that have a
Yep.
book value between 250 to $750 million under management.
Mm-hmm.
Why that range is very simple. It's too small for private equity
Yep.
because the fees aren't big enough, the work is the same, and it's, you're in the weeds, right?
Yep.
But I've lived my whole life on the concrete. Like I'm in the
Yep.
cloud, in the concrete, or whatever, Gary Vee says, right? The clouds in the dirt, whatever. It's like
Yep.
that's just how I'm built, right? I'm a Trenton makes world takes kid. I don't have I'm strategic about how I use my time, but I also,
Yep.
there's a piece of me that loves the contact and I can't deny it, right? I played
Yep.
football the same way. I would run into you to get to the tackle versus run around you just because I kind of liked it,
Yep.
sick as that may sound. So again, you got to know yourself. I've learned myself, and that's who I am. So you got to be built for that kind of thing if that's what you're going to do. But we are. And so why we're focused on that is very simple. There's $130 trillion of assets under management across all registered investment advisors in the market today. The
Mm-hmm.
compound annual growth rate of that is predicted at 10% a year through 2032.
Yep.
So the next 7 years, that 129 under management is going to grow 10% compounded for the next 7 years
Yep.
predicted, right? It's managed by roughly 16,000 firms
Mm-hmm. Mm-hmm.
in total. 93% of those have less than $1 billion under management.
Yep.
So if you know what fragmentation is, there's nothing more
Yep.
fragmented than that. I mean,
Yep.
you take a glass and you throw it on the ground, it's more
Yep.
fragmented than that. And so what does that mean? Well, that means that roll-ups, consolidation are inevitable. Now, this happened already, right? So this is not a new idea. This
Yep.
is a new version of a already existing idea that's not going to continue, that's not going to stop to continue, right? In 22 and 23, there was a lot of private equity formed to roll up the billion to $2 billion to $3 billion AUM shops. Now, in perspective, at like 40 basis points on AUM, you're talking about on $100 million under management, it might be generating $450,000 a year in revenue.
Yep.
And the EBITDA on that might only be 25%. So you're like,
Yep.
if somebody has $100 million under management, they're basically making 10 grand a month take home pay.
Yeah. Yeah. Yeah.
Right.
I think there's a big people don't understand that. I think they think the big numbers on the AUM side, anything over 9 figures is good, but actually it takes 9 figures. You're breaking even pretty much if you have a team. Yeah.
But here's the interesting thing. So out of the 15,000 firms that make up 93% of that 130 trillion, but
Yep.
have less than $1 billion each, right? There are 7,000, so call it half, just about half.
Yep.
Where the principal, meaning the lead advisor, right, who's doing the client stuff, is over 55.
Yep.
So what does that mean? Well, that means that just like everybody else financially anyway, they want to retire in the next 10 years. They got a good life,
Yep.
but they'd like to retire. But because of technology, because of TikTok, because of YouTube, because of any number of opportunities, not only is it harder to find people that want to work at Starbucks, it's harder to find people that want to go into financial services and get licensed, deal with compliance and do that, especially in the younger generation. Now, I think that curve is going to shift back. I think there's a whole new crop of financial professionals that are going to go in and find real meaning working with clients and helping them do the thing they can't do for themselves, whether it be plan, their next like 10 years or buy a house for the first time or have insurance for the kids. Like, I believe there's going to be an uptick in that. But the reality is until there's an uptick, there's only two places that person can really go, maybe three, right? So if I'm 55 and up and I want to kind of start to sunset, I have a very personal business, right? And so my book comes with me wherever I go. So
It's
it's
the
hard for me
relationships
to
you've
sell that.
built, it's the trust you've built with, a dozen investors at most. I mean, it's not, it's you. They buy you, they trust you. It's very tough to you're not selling an e-commerce brand.
Right.
So
And
very
and
different.
so but you're a small business.
Yeah.
And if in 250 to 750 means you're doing somewhere, north of seven figures in revenue, up
Yeah.
to almost eight figures well, not eight figures in revenue, but you're doing 5 million, in revenue as a sweet spot with
Yep.
roughly, a buck and a quarter as your EBITDA, so $100,000 a month. So I'm very focused on $100,000 a month at a time, rolling that up to get to 6-7 billion under management over the next 3 years
Yep.
under a very human brand where we create succession plans for those principals.
Yep.
We create an ESOP for the people that work inside of the thing so that it's a truly different kind of model than just pumping out as an IPO.
Yep.
And at the same time, what we're really doing is we're going to go roll up $6 to $7 billion in assets under management. We know we can get the EBITDA to 40, maybe even 50%. So we can improve EBITDA between the AI technology,
Yep.
retooling,
Yep.
and just the efficiency.
Consolidation. Yep.
And so now we've invented this unique data model that's kind of built on agentic AI replacing certain SaaS, doing things like that inside of it, but we're doing it slowly over time and without, and these firms could never afford that, by the way, right? They
Yep.
can't go afford to do it. And so we
Also, they
come
don't have the
in,
skill set, right? It's coming back to being a creature of habit. This is what they've been doing, some of them for 20, 30 years. Hiring a 25-year-old to talk about AI is not what they do. I know these guys, I've met them. It's they
and
just
no
want to do
offense to
what
the
they do.
25-year-old, the 25-year-old doesn't appreciate the value of what they bring to their
What they
client
know.
base because they
Yes.
don't have the pattern recognition and it's not their fault.
Yeah. Yeah.
They can learn it over time, but they're
Yeah.
not going to bring it inherently. So you're where we see the sweet spot is that's one vertical we really like. And the reason why we like it is
Yeah.
because it creates a flywheel for our other strategy, which is in parallel to that, which is buying up cash flow businesses that are really
Yep.
strong and unique, that have been around for a while, that are kind of boring, meaning they solve a need that's never going away.
Any
Um,
examples? Markets,
yeah, like
niches?
the one we're doing, it's the first one that we're doing actually this month is one that's in the trading indicator space.
Hmm.
And it's probably least indicative of kind of some of the things we're looking for, but it's just too opportunistic and too valuable in another way as it relates to the content and publishing and distribution of things to a community of common interest, which are traders and
Yep.
investors. So it was strategic, but it's basically a $5.7 million business that grew from 3 million last year to 5.7 this year.
Yep.
Throws off about 2.6 million worth of free cash flow.
Yep.
We're buying it, for under $7 million,
Yep.
and with a material earnout. And we're going to grow it. We think we can hit, 7.5 million in the first 12 months based on current momentum. But what we're really buying is
Yep.
we're buying a Discord community that's hyper engaged with over
Yep.
30,000 people and growing that are
Yep.
all investors. That's one. Now, so how do we use the RIA over here with
Yep.
the venture studio and the model over here? The venture studio invents the technology that retools these companies. We sell that to
Yep.
other clients. The advisory does fractional C-suite stuff. We sell that to other clients. But now what the fund is going to do is basically make these acquisitions and use the
Yep.
advisory and the rent and the technology from here to be a customer of itself,
Yep.
right, and improve the RIA business. But now what we're also doing is every $1 billion in AUM we roll up, statistically, roughly 13% of that goes into alternative assets,
Hmm.
commercial real
Hmm.
estate funds, private credit, startups, all that stuff, right? Venture,
Yep.
that's all called alternative assets. So Atomic's really a boutique alternative asset management firm.
Yep.
We happen to own what we're turning into a virtual family office model that'll have RIA and a bunch of those services, and we'll roll that up. But then we're buying these other businesses here. Like I can't go buy a building for $6.75 million anywhere in the world right now. I don't care. You
Hmm.
name the best city with the best economics. I can't buy a building for $6.7 million with less than 10% down,
Yep.
right? That's going to throw
Yep.
off 200,000 a month worth of free cash flow. Like that
Yep.
doesn't exist, but I can buy a small business a lot.
Yep.
And I don't need 100 of them, right, to get a
Yep.
73% IRR before I start harvesting Bitcoin. I need 12 to 15 RIAs,
Yep.
and then I need 12 to 15 maybe of the ones I just mentioned in that $5 to $50 million revenue sweet spot,
Yep. Yep.
right? With EBITDA. And I can print my IRR and I
Yep.
can keep my life simple. And I'm saying that because again, simple is, the thing that'll
Yep.
work. Complexity is the enemy of all execution. But the flywheel is those assets are going to be bought by atomic search funds. Well, the search funds
Okay.
are a
So
product,
the small businesses are being bought by yeah,
a
got
search
it.
fund for
Yep.
acquiring small businesses from
Yep.
people that are 55 and up that have,
Yep.
electrician practice that's throwing off a couple million a year
Sure.
for 43. Electricians are in high demand,
Yep.
right? So like they're never going away with all the data centers, with all the housing we have to
Yep.
build in this country
Yep.
alone. Like there's not enough of them.
Yep.
And so someone who's been around doing it's just like call your dentist, right?
Yep.
I'm not saying I'm going to buy dentists. I'm just giving people ideas. Call
Yep.
your dentist and try and get in. You're not getting in for 3 months if you
Yep.
like.
Yep.
I don't know anybody who can call their dentist and go in the same day unless it's like a. So there's a lot of security to that business, right?
Yep.
People
Yep.
can't not have teeth, and so when you think about those opportunities, and none of those businesses are highly technical, but think about all the
Yep.
efficiencies in there that operationalized AI could
Yep.
do if you had operationalized AI technology and chops, right? Like we do, and you're not having to bear the cost of hiring somebody else to do it. So that's
Yep.
part of our unique, wheel, right? But the funding is the key because you still got to go convince investors to back your fund.
Yep.
So where I'm trying to go is I want to raise money one time, close this
Yep.
out, and never have to raise money again from anyone else because I'll own a book of RIAs whose whole
Yep.
job is to take 13% and find alternative assets for their clients. Now, I can't mandate
Got
it
it.
because
Yep.
that would break the independent thing, but I don't have to mandate it because last time I checked, $7 billion, 13% of $6 billion is roughly $780 million a year that's going into
Yep.
alt. And if all I have to do is say, hey, here's a search fund that we're going to put in front of a roadshow, and I take it around that network of RIAs, if
Yep.
10% of the advisors allocate a client into it, I'm looking at $78 million in search funds.
Hmm.
I can buy some of these small businesses with nothing down using an annuity. I can buy some of them
Yep.
with
Yep.
10% down in SBA. And so
Yep.
78 million is like a whole new fund,
Yep.
right? I mean, how
Yep.
many
Yep.
businesses could you roll up for 78 million when you're
Especially
calling?
with cash flow. I mean, that's what people don't understand is it's very different buying these asset heavy and low cash flow businesses versus cash flowing businesses because the example you gave, I know those businesses very well, like semi SaaS, education, online, high margins, 5 to 20 million a year. Those are usually run, especially after a few years, the owners are usually bored. And you can come in with a fresh pair of eyes and literally double the business within 12 months. I've done it. So but try doing it in a brick and mortar business. Much tougher, right? If it's just the fixed costs are higher. Hiring is tougher, especially if you're constrained by just hiring in your city. Anything SaaS versus digital is just a a a huge opportunity and will be for the next 10 years.
Well, and I
Yeah.
I kind of I'll clarify on that because I actually am less bullish SaaS as a business model, which is a whole other conversation. But what you're saying is, I think directionally right, meaning like technology,
Yeah.
enabled.
It's
But I'm
correct. It's
very
the
focused
mix
on, and
of
there's two pieces of the thing that are very kind of maybe contrarian to what people might think we do, right? Because technology, Web3, like all this stuff, right? It's very AI, like that's the venture studio side. But I'm making a bet on something personal,
yep.
which is every day my wife and I more and more want less technology. So I'm in
Yeah.
technology. I want less of it,
Yep.
right? We moved all around the country to basically put our
Yep.
teenager in a school where there's no technology,
Yep.
right? Because I've built mobile phone operating systems to try and create, optionality for people because we don't have choice. We have the illusion of choice. I've seen that side. So I am one who's accepted the reality of technology is mostly good, but again, technology just is. It's
Yep.
neither good nor bad. It's what we do with it.
Yep.
And what we do with it a lot of times is what we unconsciously don't realize we're letting it do to us. And so I'm of the opinion that it's my job and my mission to try and create more humanity, not less humanity in the business marketplace. And I want to drive a return. And so how I'm doing that is I'm very focused on, I don't really care. Obviously, growth is going to be an imperative, but I don't have to double every business we acquire in the
Yep.
SMB. First
Yep.
of all, like you said, it's not easy to do. It's hard to do.
Yep. Yep.
I would argue, I don't think it's necessary. And here's why, because the other side of this bet is if every dollar I acquire in free cash flow and my focus discipline is I'm going to grow it, but not use more than 50% of
Yep.
the free cash flow, both as rainy day and growth capital, because
Yep.
50% of it is going into Bitcoin dollar cost averaging in chunks while I can for as long as I can over the next 5 years.
Yep.
Then what I'm basically saying is I'm going to ride the asymmetric return of this exponential age on my balance sheet, but I'm going
Yep.
to focus on the P&L being what keeps it human to human or
Yep.
amplifies the human experience between my customer and the thing I just bought. If it's going to put technology in to try and be flashy and grow fast, I'm not going to do it.
Yep.
If it's
Yep.
going to require me to message to my customer why we're the technically best thing out there, I'm not going to do it. With the RIAs, they don't care about technology. They just recognize it's a force. What they want is more time with their client. What the client wants is more time with them, even if all the trading is automated, which it likely
Yep.
will be. Right? The reality is a human still wants to look someone in the mind when it comes to their future retirement and feel
Yep.
comforted. And so there's a value to that, and that's not going away. Even if we commoditize every arbitrage trade there is, which we already are and will, even if all that spread gets squeezed down faster than it ever has, the
Yep.
RIA will have a new value. And so the RIA that can actually be there and work on that person's holistic approach is going to be the one who gets the AUM, and that AUM then feeds my
Yep.
flywheel. So
Yep.
I am clarifying that as bullish as I am on technology, I'm more bullish on human to human experiences inside of the business. And I just know I can impact them more with small business because they built themselves on a reputation that's not scalable.
Yep.
But I can now create scalability without having them change who they are.
100%. So one thing we've done over the years is use technology to make the community and the product stickier. So it's always about the humans, right? The interaction, the community, but putting them, you mentioned Discord, that's one of them, putting them into something that forces them to stick together, um, is the future of SaaS. SaaS right now, you can see like these AI agents coming out every week. There's a new tool to vibe code. Now that's the new trend over the last 2, 3 weeks. Building a SaaS is going to be it's a commodity. It's becoming commoditized, right? It's what it does for the human at the end using it and the community gathering around it.
Well, and I think that's the thing is that SaaS doesn't disappear
Yeah,
overnight, maybe at some point, but it doesn't disappear because humans will still be buying certain things.
yeah, yeah, yeah,
The more we start to get to the point where bots or agents, whatever you want, are buying from other agents, SaaS no longer matters, right?
yeah,
Because an agent, we don't know how an agent's going to buy from another agent yet.
yeah,
We just know they won't buy the same way humans do. SaaS was packaged up just like a gym membership, where it's like you
yeah,
came in because you want to lose weight or improve your bench, but we sell you like one low price, and some people come and over-index on their use, and others never show up for 6 months and
yeah,
never
yeah,
quit because they lie to themselves that they're going to go to the gym. That's like SaaS, right? Because humans
yeah,
buy the way we buy the one or two features we really care about. We don't use 98% of the rest. Agents will not do that. We just know they won't. They will be because they're programmed to be efficient. So they will buy the
yeah,
feature they want only, and they'll expect microtransactions. Again, totally different conversation. But what I'm saying is the market share for SaaS is going to be reduced to who are the humans buying SaaS and for what purpose?
yeah,
Because as the agentic AIs proliferate, they will start to buy from each other, whether it's
yeah,
API calls or whatever, and they will not package it the same way. They will not want it packaged that way. They won't justify it. And so, since we haven't seen that play out, all we can predict is that the growth model for SaaS, which has driven VC for the last 15 years, is over.
yeah,
We don't know how it's going to look.
100%.
We just know that growth model is no longer predictably right.
Yeah, yeah, I
And
agree.
I apologize. I have to run to another one, but I mean, I would love to do a
No,
cut
this is great. Let's call this part one. We'll do part two in a few weeks. This is great. I definitely want to get more into like the acquisition side of things, talk more about like Web3 because there's a lot that
Yeah, let's do
clearly
that.
you've done a lot. So let's talk about that next time. So we'll wrap it up for this time. Thank you for this part one, and we'll catch you on the next one.
Can't wait to be back. This was
All
phenomenal.
right.
Thank you so much. Thanks,
Thank you
everybody.
for coming. Hey, thanks for watching. If you got value from this episode, you're going to love what's coming next. So subscribe now. We drop new episodes and videos several times a week featuring power players, market movers, and insiders from the financial world. And if you want access to deals and insights we only share privately, hit the links in the description and we'll see you on the next show.